Hey there guys, in this video I'm gonna be teaching guys on how to create a profitable trading plan as for the year 2025. So basically this video is going to teach you on the essential components to include in a trading plan. So first thing first, we need to know exactly what is a trading plan. So a trading plan is a comprehensive and structured strategy designed to guide a trader's decision in the financial markets. It serves as a roadmap for consistent, disciplined trading and is essential for minimizing emotional decision making and maximizing potential profits. So what are we saying? So a trading plan is supposed to give a trader certain conditions to be made for him to take certain decisions. These are rules that will guide him in making decisions. So basically a trader needs to follow these rules which will guide him in taking steps. So this is a trading plan, just the same as for sailors. They do need a plan on which route they're going to be sailing across. If they're going to meet certain types of winds, they have to have a plan B. Same as a trader, you need to have a trading plan that will actually guide you when you meet certain rules, certain conditions which you are not expecting. You know how to react since your trading plan is already catered for that. So in a trading plan there are three sections which we're going to cover. So first thing first, we're going to be learning about risk management, a trading strategy, and also psychology. Yes, so basically these are the three main components of a trading plan, and if I was going to weigh, I would weigh 60% on psychology, then 20% on trading strategy, 20% on risk management. So let's dive in deeper into these three aspects. Okay, so when it comes to risk management, we are talking about how a trader is going to be risking to make certain returns. This is how much a trader is going to be risking to make certain returns. This can also be found on position sizing, whereby a trader can risk 1% of his income of the total capital in his balance in order for that trader to make 3%. So traders tend to have different tests. Others stick to 1%, whereas others can see that as little and even use 5% to risk. The more you leverage, the more the gain, and vice versa. So if you are using 5% as your risk and you are having a risk reward of 1:2, you gain 10% if that trade plays in your favor. However, if you risk 5% and that trade doesn't play in your favor, you lose 5% of your total income. So the more you risk, the more the returns, and also the more you lose when you are wrong. So under risk management, we can talk about the risk to reward ratio. The risk to reward ratio compares the potential risk of a trade to its potential reward. This ratio helps assess whether a trade is worth taking. So some traders will actually have a minimum of 1:2. If a trade idea is portraying a RR of 1:1.6, they won't take that trade because it's not meeting their minimum demands or their risk to reward ratio. Commonly traders aim for a minimum risk to reward of 1:2 or higher. For example, if you are risking $100, you should aim for a potential reward of at least 200. So in trading, you should make more money than the money you are risking in order for you to stay in the game long term. In order for you to be profitable, you should be risking less to be making more. That's the concept of being profitable. You never have 100% win rate. You never have 100% blue trades, winning trades. However, the concept is to win more than what you are losing. Okay, a good risk to reward ratio helps ensure that your profits over time outpace your losses, even if you have a losing streak. this is the concept which I was explaining before, that your risk to reward ratio must be good, that is a minimum of 1 to 2, meaning that you lose 1 to gain 2, and every time you do this you remain profitable. Then also under risk management we also have stop loss orders. A stop loss order is an automatic order placed to sell or buy a security when its price moves against your position by a certain amount. Never trade without a stop loss order. So what are we saying? So we are saying a stop loss order, it prevents a trade from wiping your total balance in your account. So we are saying that, for example, you've got 100 US and you are risking $10, so you're risking 10%. So what does that mean? That means that your stop loss will close you at $90. So it has prevented your account from being wiped, from being blown. So stop loss orders are actually a good thing. Do not have a mental stop loss, but if the market crosses above this line or below this line, that's when you're close. You need to have a stop loss order. Calculate your risk. It is a risk management tool that helps limit losses in a trade by defining the maximum amount you are willing to lose. Example, if you buy a stock at $50, you would set a stop loss at $45, limiting your potential loss to $5 per share if the price falls. Okay, then under risk management plan, this is an example. I've compounded everything into creating a system for risk management, whereby let's say you've got 10,000 account and you're trading stocks with the following risk management setup. Risking 1% per trade of total capital, that is 100 per trade. Stop loss 800 below enterprise. Next to reward is 1:2, so you'll be targeting 200 for each $100 which you are risking. The more you do this consistently, I guarantee you that you're going to be profitable. So risk management is essential for you to become a profitable trader. You can never become profitable without the risk management concept. So you have to master risk management. Then also you have to master the other two things which are going to dive in deeper. Let's go. So we can talk about the trading strategy. A trading strategy is a set of rules or guidelines that traders use to make decisions in the financial markets. A trading strategy will have your entry and exit rules. A trading strategy includes specific rules for entering and exiting trades. Entry rules specify the conditions under which you buy or sell a security. These conditions must involve certain indicators, chart patterns, or price levels. Exit rules define where you should close a trade to lock in profits or cut losses. This could be based on reaching a profit target or a stop loss level or a reversal signal. So a trading strategy will often rely on one or more types of market analysis. This can either be technical analysis using price charts, indicators, patterns to forecast future price movements. Traders analyze price movements to identify trends and key levels of support and resistance. Fundamental analysis analyzing the economic, financial, and other qualitative and quantitative factors that can influence an asset's price, e.g. earning reports, economic data. This is trading news, where consumer price index data is released on non-farm payroll. Okay, under trading strategies, traders can actually use different trading strategies. We've got price action, we've got smart money concepts, we've got ICT, then we've got indicators, EMA, alligator. Under our YouTube channel, we have provided the price action strategy from a beginner level to an advanced level, whereby even a 2-year-old can understand our strategy. So basically, price action is what we use on our YouTube channel. We do not have the other strategies under our YouTube channel. So traders, choose a strategy which you feel well versed with, and then start applying it and following it religiously. Do not change strategy to strategy, because you actually remain in the same cycle whereby you think that the strategy is not giving you results, whereas there is no 100% win rate, but you have to make that strategy to suit your personality. Trading psychology. Trading psychology refers to the emotional and mental aspects that influence a trader's behavior, decisions, and performance in the financial markets. Understanding and mastering trading psychology is crucial because emotions like fear, greed, and overconfidence can significantly affect trading outcomes. Even the best strategy or system may fail if a trader's mindset is not well managed. That's the reason why I'm saying trading psychology weighs 60% of the whole toolbox of trading, whereas the other 20% goes to trading strategy and the other 20% goes to risk management. So under trading psychology, you have to master your psychology, your mindset, your emotions, how you react to certain conditions within the market. So we're going to dive in deeper, explaining the common emotions which traders face when they're trading and how to overcome the same patterns. Let's go. Okay, so these are the three main emotions which we're going to be talking about. Actually, there are four. So we've got fear, greed, and overconfidence, and anger. So under fear, we see one of the most common emotions traders face. Fear often arises during market volatility, leading to hesitation or premature exits and entries. We can also talk about FOMO, that is fear of missing out. We can also talk about fear of loss, may make a trader close a trade before it is profit target, even though that trade is on track. So how do we eliminate fear in trading? So basically, fear in trading requires you to have confidence in your strategy. So how do we have confidence in your strategy? You need to backtest. So the only thing to eliminate fear is to backtest. Actually, you cannot eliminate fear, but you can actually comprehend it. You can actually reduce it by having confidence. So having confidence in your strategy, believing that your strategy works, leaving your trade to run to TP. This is all coming from a backtesting stage whereby you now know your strategy, you now know it well. So fear of missing out, this one is actually common in beginner traders whereby they want to jump into a trade and they want to eat profits, but that trade isn't matured yet, and then from there that trade will reverse, and then they'll close in loss because they think that the trade is not reversing. Once they close that trade, then that trade will continue their way. This has happened to me several times. And then this is the common emotion, fear. So fear of leaving your trade to run to TP, fear of entering into the market, you're still waiting for more confirmations, whereas the market has already given you confirmations. This is a fear based on not having confidence. So you're supposed to have confidence in your trades. Backtest your strategy. Backtest your strategy. Then also we've got greed. So greed is that desire for more profits, often leading to excessive risk trading or holding positions for too long. So let's explain how greed affects traders. So basically you're trading and then you have a risk to reward of 1:2. With a risk to reward of 1:2, your trade has hit 1:2, and then from there after hitting 1:2, you still want to be in that trade. You are not taking your profits, you do one more, then that trade will eventually reverse. After reversing, it will wipe your profits, and after that your trade will close in losses. This is greed. And overconfidence. After a few successful trades, a trader may become overly confident, leading them to take excessive risk or deviate from their strategy. So basically, you mustn't trade with ego. You mustn't trade with ego. Manage your trading psychology. Manage your mindset. That's the reason why we are saying you cannot eliminate these emotions, but one thing you can do is to master them, whereby you can now feel like, okay, I'm now being overconfident with what I'm doing. I need to take a break. You cannot eliminate these emotions, but you can master them. There's no way by a trader can trade without these emotions, but you can master them by, okay, I've hit my 1:3 risk to reward ratio, but I have to close. Well, even the setup is is giving you more. Instead, I can push your stop loss to 1 to 3 risk to reward and let the other play out, rather than actually not closing. What if the market reflects and then it will wipe you out? Then we can also talk about regret. Okay, regret comes from a sense of loss after a trade goes wrong. It can lead to revenge trading, where a trader tries to recover losses quickly by taking more aggressive trades. Example, after a significant loss, a trader may jump into another trade impulsively to get even in the market, which often results in further losses. I've been through this process whereby after your stop loss has been hit, you look for another setup, then you enter, then your stop loss is hit again. So the thing of you trading after your stop loss has been hit without a proper plan will actually lead to more losses. So I suggest that when you are trading, take 2 trades a day. If you're a trade trader, 2 trades a day, stop loss hit or whether win in both trades, then you're done for that day. You should have a plan. So a trader must have a plan which will incorporate everything about if they have a winning day, if they have a losing day, how they'll react to that. If you are trading without a proper plan, you actually make impulsive decisions which will actually ruin your trading account or make you blow your account. So how to overcome these problems? So basically, the first thing is setting realistic expectations. You have to accept that trading is difficult. Trading needs you to follow rules. Trading needs a plan. By accepting these things, you actually set your mind to follow these steps. Be disciplined, be consistent, follow your trading plan religiously. Journal down all your trades, following where you made a mistake, how you reacted, and then reflect on your trades so that you become better. In forex trading, we learn from reflecting from our mistakes. We learn from the past in order to predict the future and to become better. We need to accept losses. In trading, losses are part of the game. We can never trade without losses. Every trader goes through the streak of losses. So do not be hard on yourself when you face losses, because losses are part of forex trading. Never compare yourself to others. Your journey is different from my journey. Your journey is different from other traders' journey. Other people may be showing flashy lifestyle, but focus on the grind, focus on the chart. The lifestyle will follow later. This is the concept of trading. Above all, guys, follow your plan. Signing out. Thank you for being with us up to the end of the video.